Hi and welcome to this week's Property Insider video. Today, Dr. Andrew Wilson and I discuss the latest property market data, but also the implications of the Reserve Bank's interest rate drop, as well as its quantitative easing program. What will that mean for you, for your credit cards, for the value of your home, and for our property markets? We'll also discuss the latest building approval data, lending data. So lots of information in today's show to give you a better understanding of what's happening in our property markets. If you want to keep up to date with this on a regular basis, please subscribe to our YouTube channel and click the little bell icon so that YouTube can let you know when our show comes out each week. Cup Day is famous for rate cuts and interest rate rises, and the Reserve Bank didn't disappoint us this year, making the historic decision to cut the cash rate by 0.15%, slashing official rates to 0.1%. It also announced a broad-based quantitative easing program. While the economic boost of the rate cuts likely to be small compared to that provided by the recent budget, the further reduction in borrowing costs, that's going to support households, it's going to support corporate finance, it's going to boost housing demand, and it's going to keep the Australian dollar lower than it would have otherwise been. For investors, it means interest rates are going to be low for even longer. A rate hike's really unlikely before 2024. So to discuss the implications of this for our property markets and the economy in general, as well as give an update on the latest property data, I'm joined by Dr. Andrew Wilson, Chief Economist of My Housing Market. Hello, Andrew.
Good morning, Michael. We certainly continue to live in interesting times, don't we?
It has been an interesting week here in Australia and overseas. In Australia, the regular beginning of the month data given by a number of providers has shown us the gentle turning of our property markets. But as you've been predicting that for the last few weeks now, and at the same time, there's the American election, which at the time of us recording this, well, the result isn't known yet, but the implications will
Yeah.
affect the world economy, as will the second wave of coronavirus infections that are spiking in Europe and the
Yes.
USA. It's leading to lockdowns around Europe and in other countries. I guess these factors were probably part of the RBA's thinking behind their decision this week. But even before these lockdowns overseas, the RBA signalled it was going to cut the cash rate. But the escalation of the lockdowns probably means that the global economic growth is going to be less and we're going to need more stimulus locally. But before we discuss that, Andrew, let's see what's happened to our property markets over the last week.
So thank you, Michael. Yes, the week that was in our housing markets, we start off as usual with the latest weekend auction results. Another strong weekend for really all capital city markets, auction markets. Sydney just under that 80% clearance rate. Will we have the boom word once we get to 80%? Well, let's wait and see if we do get there. But strong listing numbers as well in Sydney, well ahead of the same weekend last year. But of course, we do have these new online auctions, which are adding to our traditional auction environment, but certainly plenty of auctions and plenty of competition for those properties in Sydney with a near 80% clearance rate. Melbourne's clearance rate surged, highest rate for quite some time, 78%. Also, its auction numbers were higher than the previous weekend. And quite interesting, of course, it was the Cup long weekend in Melbourne, and the auction numbers were well ahead of the same time last year, but it certainly is a different year this year over the Cup weekend compared to last year. But certainly buyers are up and about, and sellers are also back into the market in Melbourne now. Those shutdown restrictions have eased and will continue to ease. Brisbane, Adelaide and Canberra, strong results, even though that Brisbane rate certainly lower by comparison with the others. That's quite a good result for Brisbane, and Adelaide and particularly Canberra continue to produce strong results. So really no sign of any downward or easing in our weekend auction markets. The trend is clearly upwards, and we can see that with the Sydney results there. That trend has been rising now for a number of months since the winter, and we can see the top regions for auction rates, clearance rates in Sydney at the weekend. Northern Beaches again every weekend. We report the Northern Beaches as being the strongest region in Sydney, closely followed by the Upper North Shore and the Inner West, all higher priced areas, and finding plenty of buyers there and high clearance rates. Melbourne's, as we said, the Melbourne clearance rate highest for quite some time, and that trend is clearly rising in Melbourne. Top performing regions in Melbourne at the weekend were the western suburbs for 2 weeks in a row, 2 weekends in a row, over 80%. and the inner south at just over 80%. Southeast at 100% clearance rate, but just 3 auction listings there. So we need more results to get, I guess, a better indication of underlying strength in that market. And we can see, if we look forward now, we're continuing to see an increase in auction numbers in Melbourne over the next fortnight, rising up to around about 600 in 2 weeks' time. So sellers still coming into the market, and be even more encouraged with those higher clearance rates at the weekend. As usual, we'll look at new listings data. This is the National New Listings Index. After falling away earlier in the week, it's now starting to recover again. New listings at the highest level for the year, certainly higher than the beginning pre-coronavirus period. Sellers are still happy to test the market. Why wouldn't they, given the increase in, we've seen clearance rates, and as we'll see in a minute, new sales as well. Compared to last year, we're still a little bit below where we were at the same time last year, but really the market is quite similar in terms of new listings coming through this year compared to last year. We must remember that last year was a strengthening market environment as well. New listings over the week, Melbourne continues to rise strongly with new listings coming from a low base, we know, but Melbourne was the top performer for new listings. Some consolidation and marginal falling over in new listings in the other capitals this week compared to the previous week. We can see that change now. Volumes of new listings now. Melbourne is now higher in terms of the new listings volumes over the past week compared to Sydney, 20% more new listings. You can see that change over the last week where it was 15% below. So Melbourne certainly is the story in terms of the rejuvenation of the market. Talking of sales, we can see a consolidation of strong numbers of new sales in Sydney over the past week, higher than the previous week. In Melbourne, we had a spectacular result, a real surge in newly reported sales in Melbourne over the week, climbing up towards those pre-coronavirus peaks, but not to be surprised, that pent-up demand and supply is now being released in the Melbourne property market with restrictions eased. And we can see Brisbane there continuing to rise. Brisbane is the strongest market for new sales this year. That second half of the year market in Brisbane is really chugging along. Melbourne, again, as we saw that steep increase over the week, was the top performance, up by 60% in terms of newly reported sales. Other markets are by and large consolidating their position over the past week. And we can see that Melbourne is now approaching the number of new sales in terms of volumes, just 10% fewer than Sydney's newly reported sales over the week. And you can see a big climb compared to the position of the previous week, where there was 40% fewer new sales compared to Sydney. So Melbourne is certainly onwards and upwards for both buyers and sellers at the moment. So the week that was in the economy, the share market, latest share market data shows a positive bounce from the Reserve Bank's announcement of an interest rate cut. No surprise there. After some easing over the past week, the Australian dollar has been falling in anticipation of the lower interest rate. Of course, it bounced back when that was confirmed by the Reserve Bank on Melbourne Cup Day. But we would expect the dollar to perhaps start to fall below 70%. That's the plan, 70 cents. That's the plan from Reserve Bank. So we'll see how that pans out in coming days and weeks. We had new home loan data over the last for September released this week as well. Another big result. Not quite the strength of the record growth rate of August, but still a very strong result. Owner-occupier lending continues to track at record levels. First-home buyer and investor loans are also rising as well. We can see over September, no surprise that Victoria, with still the depth of the shutdown impacting the market in terms of the capacity to lend, or the ability, I guess, to physically take out a loan, that was the underperformer. All other states were quite strong over the month. Similarly, when we look this year so far versus the same period last year, the first 9 months of last year versus the same of this year, strong growth across the board, with New South Wales leading the pack in terms of total new loans. First home buyers, again, Victoria, the underperformer through the shutdown period of September, but first home buyer numbers rising quite strongly over the month. And if we can see that position for investors versus owner-occupiers, Victoria down for both owner-occupiers and investors. Other states have had increases in both owner-occupiers and investors over the month. And of course, that investor lending, although rising, is coming from a low base, as we saw with the first report. Building loans, we saw one of the big contributors to that increase in new home lending or in home lending over September was a remarkable surge in loans for the building of new homes. Of course, that reflects those government policies that are activating the market quite strongly at the moment. Another very strong result from new home lending for the construction of new homes, and that'll likely continue, particularly till the end of the year when the new builder policy expires. We can see Victoria again, the strongest result in terms of home building loans over September. And we can see that the monthly change for those new house buildings, that Perth was the strongest result in terms of the actual change from month to month. Building approvals also came out this week. We can see a rise in house building approvals, still some weakness in those unit building approvals, but of course unit approvals are quite volatile, so we need to see a longer trend to see that. But no surprise that the building approvals for houses increased over September. And if we look at the trend going forward, this is annualized monthly data. So this takes the number of approvals over the past year on a month-to-month basis, a rolling monthly trend. And that shows how steeply the approval for units has fallen since its peak. Nearly half the volume of units on an annual basis is now being approved nationally, but it has at least found its base at the moment. But when we look at houses, that's been a lot more, these approvals for new houses has been a lot steadier. And we can see now that that trend is starting to rise with that home builder government stimulus package. But interestingly enough, we've only got 3 months on this data to run with that package, which ends at the end of this year. But we still have new home approvals on an annual basis trending still below where they were at their peak in 2018. So even though we're getting strong numbers going forward, we're still not back to the levels where we were at the peak of the current cycle. Just some other quick data updates for the week. CPI was released last week, up 1.6% over September, which followed that 1.9% fall over the June quarter. Of course, that volatility reflects the coronavirus shutdown. So up and down, we will need to have a more consistent period without shutdowns to get a better read for inflation. We also had building costs up by 0.2% over September. That data was released, which was down from a sharp rise of 1.2% over June. But Sydney has the highest annual building costs for houses, up by 2.7%. As you mentioned, Michael, and we'll discuss, RBA cut rates to 0.1% over November and has broadened the quantitative easing policies. And going forward, we're likely to see some share market and dollar volatility, likely from results of the US election. So that's all for a very busy week this week, Michael.
So much has happened in just 1 week. And
Yes.
when you put all those bits together, Andrew, they were all positive for our property markets moving forward. But let's discuss the big event this week, which was the drop in interest rate. Now, it had been signalled, but what's behind the easing? What was in the minds of the Reserve Bank board when they made this decision?
Well, I think that firstly, the November tradition sort of was revived, which was the Melbourne Cup move, which in previous years became almost a routine for the Reserve Bank to, as you mentioned, Michael, to either cut or increase interest rates. The reasoning behind that is November's a good time to cut because it still gives some time to provide the economy with stimulus before the end of year shutdown. And really the next time that you can sort of really make a move on interest rate that counts is probably March. So, because February, again, even though we've seen some cuts or moves in March, in February, we'd be more likely to have a move in March because we need to wait for the data to come out to justify the move. So really, I think that was one of the factors. It was, if we were going to cut, we have to cut in November. It's the last cut, of course, likely to be the last cut, almost certainly the last cut. The Reserve Bank has said it won't go to zero. So I think that's the first point, Michael, is that if they were going to cut, and we need to obviously get to the point where we've thrown the kitchen sink at the problem. The kitchen sink has now been thrown at the problem in terms of interest rates. We are in a good position in terms of clearly recovering our economy. So it's a good time to use that final lever to keep things turning over, I think. So that, I think, was the first reason. And obviously the big picture for cutting interest rates is that it does improve housing affordability. It gives consumers more money in their pockets, those that have got mortgages, and it obviously does the same thing for businesses. It releases gives them some more cash to either invest or to offset losses at the moment. So, and that's all, of course, on conditional that the banks pass it on, Michael.
Well, the Reserve Bank's made it a bit easier for the banks too with its bond buying program to keep interest rates low and the interest rate it's lending overnight money to the banks. So I guess it's expecting the banks to grease the wheels of industry, Andrew.
Yes, look, I think the governor sounded a little defensive to me in his statement that he made regarding the reasoning behind, particularly behind the quantitative easing, broadening quantitative easing. Firstly, he was, I guess, he seems to be a bit sensitive to the question that there's no role left for the Reserve Bank anymore, that there's no sort of ammunition left to throw at the economy, with interest rates now being what will almost certainly be their last point in terms of the low cycle. And obviously, we've just explained why they're going to cut rates and why they did it now, and that makes sense. Now, the quantitative easing is a bit more problematic from my perspective. He was very forthright in suggesting that we are to a certain degree a hostage to international forces again, which is sort of driving more quantitative easing because that's what's being undertaken by other central banks globally. Now, I'm not too sure it's been that successful, but the whole point to quantitative easing is to push down or non-mortgage interest rates, such as personal loans or credit card loans, Michael. So, I mean, that's the theory behind it, and to some degree it can work. But the issue with the Reserve Bank is not just to get those rates down and obviously to put more money in consumers and businesses' pockets with lower rates. It's also very sensitive to the dollar. And I think that that's been the main thrust here. The Reserve Bank obviously wants to get that dollar in the 60-cent range. Now, lower dollar tends to be inflationary, of course, but they're not too worried about inflation. Why would they be? They shouldn't have been worried pre-coronavirus about inflation. But anyway, they can use coronavirus as their justification for that wake-up call. But nonetheless, I think that that's the justification, that we need to follow other reserve banks with bond buying to push down those rates, or else our dollar will remain higher than what the Reserve Bank wants it to be. And of course, another factor I think which is interesting, Michael, is that the Reserve Bank mentioned that it's certainly going to be active, not just with Commonwealth bonds, but also state government bonds. And of course, we're going to have a series of state budgets coming up now. So it's, I guess, over to the state budgets now in terms of their stimulus packages, what they're going to do. And I think what the Reserve Bank is doing to some degree is it's providing some funding for those state governments in terms of purchasing their bonds. So even though the Reserve Bank states there's quite strong competition internationally for Australian government bonds, nonetheless, I think that it's welcome to have even more competition for those bonds from the Reserve Bank as well as other factors. Now, this is starting to sound a little bit like modern monetary policy, but it's sort of not, because the Reserve Bank still acts through independent third parties to purchase bonds. So it's not the government just purchasing its own bonds. At least we're in a position where our government bonds are in demand. It will push yields down as the prices of those bonds increase with higher demand, and that should act to push down other interest rates such as credit card interest rates, overdraft interest rates, which will be a positive to stimulate our economy. But I think the dollar is the main game.
Well, it's brought our interest rates down in line with most of the other countries around the world. But does that mean the Reserve Bank's now run out of bullets, Andrew?
Well, that was what they were trying to say. They haven't. But they've also mentioned that they can move into the currency market as well, if need be. So open market operations, they can start buying and selling the currency as well going forward. So they're sort of justifying their position and saying, no, they still have a role to play, and they're doing it now. We'll wait and see what happens in terms of that role. But the other interesting thing, Michael, is that from the Reserve Bank is that they're now quite clearly saying that the September quarter was quite a strong quarter for growth. So our recession will be a 2-quarter recession. Again, it's got nothing to do with the business cycle, and we're back up and running again in September. They also said that they're now looking at an 8% peak in the unemployment rate this year. I think we won't even get to 8%, but let's see what happens. And of course, the best case scenario for the unemployment rate was 10%. and many were predicting predictably outrageous levels much higher than that. But, the Reserve Bank, they were one of those that weren't as optimistic as others were in terms of the prospect of the Australian economy. But who cares? It's a good result. If we can only get to peak around 8% in this cycle, Michael, that'll be great.
Yes, totally different to what so many people were concerned about and some had forecast in those early days when really there was very little to base forecasts on. But
Exactly.
putting all these things together, we've got the various government stimulus packages, we've got freer lending coming next year, according to Josh Frydenberg. We've got greater consumer confidence. It looks like we're overcoming the coronavirus. All that together with another small drop in interest rates, and the interest rate drop isn't going to be as big this time as previous cuts. They couldn't cut it the normal 0.25%. And the other thing is the banks probably won't be able to pass it all on. But putting all that together, it's got some pretty positive implications for our property markets, Andrew.
Oh, absolutely, Michael. And property markets, as our data has been showing for quite some time now, have been building momentum clearly. And as you said, the latest price data validates that. But we've been seeing that with higher listing numbers and higher numbers of sales coming through. Victoria was dragging the chain, no surprise, but we learnt the lesson from the autumn shutdown in the other capital city markets that markets will bounce back. This has been a pause. We've pushed the pause button, Michael. The pause button has now been released and everybody's getting on with the business of buying and selling. All those decisions that were made and then were put on hold are now being activated again. So going forward, it was always going to be nothing to do with the basics or the fundamentals of the property cycle that was affecting outcomes. It was the physical restrictions on buying and selling that created that easing in the market. And now we're back to basically normal and more good news, which it is. Lower interest rates is always good news for the property market, Michael.
It's also good news for those people who put their mortgage payments on hold. A lot of people were worried about that cliff that didn't happen and saying that a lot of mortgage holders are on life support. Well, the banks have come back one after the other saying that those people who put their mortgages on hold are now back to repaying, or a large percentage of them are.
Yeah, it's been a tough year for doomsayers again, Michael, hasn't it?
Yes, but they're going to be out there. They'll find something different. But each week we will tell it as it is. Thank you so much for giving us an update of the data. And next week we'll go into much more detail. Normally we would do it in this show, but because there was so much to discuss with regard to those Reserve Bank decisions, we'll go into the deep dive in property next week. Looking forward to catching up with you then.
Yes, thank you, Michael.